We're going to switch gears now and talk about the economy with our friend David Bahnsen. David's group, the Bahnsen Group, are sponsoring tonight's program. Bahnsen Group offers comprehensive private wealth management services covering investment, tax, estate planning. They manage all their assets in-house, handcrafted like Keebler Elves, ensuring no outsourcing and meaning you always know who is handling your money. The Bahnsen Group also provides regular updates. The Dividend Cafe newsletter. I read it every day. You should too. And it's pretty affordable. It's free. Dividend Cafe, you can go to tway.tv/TBG, the Bahnsen Group. tway.tv/TBG. It's where they keep their clients and others informed on market trends. It's written by David. And again, sign up for free. I recommend it to you. It's a great daily read on the economy. And David spends a lot of time on it to make sure it's understandable. And it's great for a layperson. And it's great if you're pretty involved in the market. So we're going to talk a little bit about what's going on with the economy. David has a great view of it. You've probably seen him at some point if you watch cable business news on CNBC or on Bloomberg or on Fox Business. Without further ado, our friend, regular guest here, David Bahnsen, coming on in. David, I want to start with the question I ask everybody about the economy, my favorite John McCain line, which is, are the fundamentals of the economy strong? So let's start there. And again, grateful to you for being part of Two-Way. Oops, thought I brought David in, but I failed. There we go. So David, start with that. Are the fundamentals of the economy strong?
The fundamentals of the economy are weakening. The fundamentals of the economy are permanently strong in the sense that America is a free enterprise society. So the fundamentals of the economy are weakening right now, and I think that that's in the backdrop of where we have a lot of good things happening in the economy. There are, long-term issues that have been stagnant for some time. But what's interesting about the question is it's relative. We have things that in the past would have been really unacceptable for us as an economy. Growing at 1.5% to 2.5%. Is now considered a good thing, net of inflation. Real economic growth, 1.5% to 2.5%. We take that as a win, and that's well below what was 60 or 70 years of average growth. We grew for 3.1% from World War II to the financial crisis. So on one hand, we have a more subpar expectation for growth. And then on the other hand, that's much better than what other countries have experienced, such as Japan, the European Union, that have also gotten themselves into excessive indebtedness. But the debt to GDP ratio, I believe, is the biggest impairment for the economy. It stifles the ability to get back to trendline economic growth. And we're now compounding that in the shorter term with various elements around trade and tariff policy.
Before Rachael jumps in, I'll remind folks to raise your hand if you went on the conversation. You can ask macro or microeconomic questions, also personal wealth management questions, if you're interested in knowing where the best, David thinks the best place to be these days is. So turn it over to Rachael.
Where should I invest my money? Just kidding. I'm not going to ask you that. A lot of people talking about us being headed toward a recession at some point. More so earlier this year, it sort of went away. Is that something you worry about?
Well, I believe that we were headed to recession had it not been for the significant reversal on a lot of the things that had been threatened on April 2nd, Liberation Day. That kind of move back the other way on April 9th was probably a recession-saving move. But where things ended up netting out is not as positive as some had hoped, myself included, but is not as negative as what had been threatened that day in the Rose Garden. And the reason I think it was headed to a recession was the substantial amount of uncertainty it had created, I thought was going to lead to a total boycotting of activity in capital goods orders, capital investment, hiring decisions. And when they kind of gave a little bit of relief throughout the summer, it meant that there wasn't a total boycott, that there was still some activity, but it was clearly compressed activity. And it's absolutely clear as can be that hiring was compressed. There has been very little new hiring. There has not been substantial firings. So that's where the labor market is sort of in this kind of frozen zone, much like housing, by the way, where it isn't getting worse, but it isn't getting better. But that's not what we think of as robust job growth. You need new hirings. So Rachel, I wouldn't say a recession is an imminent threat. There isn't any data suggesting it. But I would say that very mediocre economic growth is not only a threat, but a likelihood.
David, go ahead, Rachel. Go ahead.
Oh, I was just going to say a lot of people who are watching right now probably concerned about prices and inflation. I mean, that seems to be the number one issue over and over again when you look at polling. Um, can you talk a little bit about just like grocery bills? Like, what should we expect? Like, if Trump continues on his current, the current tariffs projection, there's been a lot of people talking about, okay, companies are going to pass it to consumers. And we've seen that a little bit, but some people suggesting maybe not as much as they anticipated. What should people expect in the next year before the midterms on prices, given where we are right now?
If you're a politician, you want there to be anything other than price increases. But if you're a consumer, a wage earner, an economic actor who's not running for election, as ironic as what I'm about to say sounds, I know that I'm right. You're going to wish that they passed it on to the consumer, because the fact of the matter is that the worst outcome will end up being those items that are not passed on the consumer, that leads to a decline in corporate profits, that leads to an inevitable decline in hiring, wage growth, capital investment, business investment, the factors of production that drive our economy. And so this is one of the most frustrating things for me about the entire tariff conversation is it's understandable, especially after the politicization of the Biden era inflation. And grocery bills are what people feel, and I get that. But the tariff issue is more complex than that. There are some items that prices are going higher because of tariffs. They already have. There are some items that prices won't go higher. But that will not mean that it's a victory for the policy. If the choice is between prices going higher or corporate profits declining, and people say, good news, they passed this on to consumers, or they didn't pass it on to consumers, they absorbed it with declining profits. There is absolutely no way that doesn't lead to decline in factors of production. That means it's slower, but it will be disinflationary for all the wrong reasons. It will be downward pressure on economic growth. So when people say you're not giving a straight answer, are tariffs inflationary or not? The reason I'm not giving a straight answer is there isn't a straight answer. There's a term in economics called price inelasticity. Coffee, people are going to buy. Starbucks has an ability to pass on that expense to some degree. The coffee inflation that importers are dealing with right now is astronomical. I say that as an investor in several coffee companies. But there are plenty of items that don't have that pricing power and which corporations cannot give up market share, and therefore there will not be inflationary. They will lead to decline in profits. That leads to decline in hiring and other elements of job and economic growth that will be very bad. So I know it's a long answer to your question, Rachel, but it's the right way for us to think about it, is we're trying to pick which disaster we want, or hurricane or earthquake. I believe both of them are bad, whether it's price escalations or decline on economic growth.
All right, I was going to ask you about markets, but let's just go to questions from the community. Start with Dexter. Dexter, tell folks where you are. Question for David Bahnsen.
Well, thank you. I'm in New Hampshire and happy to join you again this evening. I'm curious, and perhaps you may have touched on it, but why haven't prices already increased under this? Is it just because there's existing stores, as many have suggested, that products have already been imported and the pricing impact hasn't hit yet? Or is this something that you think is yet to come?
Well, I think that there are products that clearly have seen price escalation already, including in shipping and freight. And I mentioned coffee. But imports were up.
Coffee.
Imports were up $20 billion in the month of July from prior year. The largest front running of imports we'd ever seen before most of the tariffs had gone into effect. The reason for the skewed GDP number in Q1 was a massive amount of imports in March. So we've seen what is the most classic case of front running twice, once before Liberation Day and once on the little pause of Liberation Day that the administration put into effect, that has substantially skewed the need to go about passing those prices on. But then I also believe you are seeing the other effect I talked about, Dexter, which is companies leading to a decline in margins.
Well, I mean, of course, with certain consumer products, that seems naturally true. They would have done so. It's just part of their buying cycle. What I'm curious is, what are the industries that you're seeing that have front loaded? Is it just coffee? Is it just consumer
No,
packaged goods, or
coffee
what is
couldn't
this?
have. It was primarily machinery and industrial goods. Keep in mind too, there was a massive amount of waivers, exemptions. There's no price inflation or corporate profit decline for Apple, since they're not paying any of them.
But
Dexter,
For
if
thank
there's
you.
no
for most computer products, for most semiconductors, for there are a lot of electrical goods, they simply aren't having to absorb it. So a lot of the carve outs, waivers, and exceptions favored things in electronic goods as well.
Dexter, thank you. Sorry about that. Chris Simmons, I don't know if your camera went off or there's another weird glitch here in the system, but if you can unmute at least, Chris, ask your question. Maybe we've lost Chris. All right, we're going to take Chris off and we're going to bring in Barton. Barton, welcome in. Tell folks who don't know where you are what's on your mind for David Bahnsen.
Thank you. It's an honor to speak to David. I was very glad that you pointed out that some companies are going to eat the tariffs, thereby decrease earnings and decrease their hiring. Point I was trying to thinking about, if the Fed cuts interest rates because the job market has been a little weak, I'm afraid that what's going to happen is long rates are going to keep going up, because cutting interest rates might be conceived as spiking inflation. And what Trump wants are long-term rates to come down. And I see stagflation as a scenario. When the Fed cuts rates, there's going to be more concerns about inflations. You're going to see widening of the yield spreads. And I think banks are probably one of the few sectors that will do well. And in terms of specific stocks, I recommend shorting Hood, because Robinhood is selling at a 52 multiple, 13 times book value, and it jumped up like 17 points today just because it got added to the S&P 500. So I'm recommending all of my friends to buy a 115.80 November 21st put spread for $8.50, just for fun.
David.
Martin, the issue about bond market yields is, and the idea of the long end going higher, and I think you may have accidentally used the term continuing to go higher.
Yes.
Or it may be that you're saying continuing to go higher because you hear the media say it all the time. Except for the long end has done nothing but go lower for the past month, 2 months, 3 months. It's one of the most bizarre things I've seen since the tariff issue, is how a narrative that anybody with CNBC.com, Bloomberg, I mean the most pedestrian of retail websites could see is untrue, get repeated over and over, that we have the bond market going down and yields going higher. The 10-year today is barely holding at 4%. It is down over 20 basis points since the weak job market, another 4 basis points today. The 30-year is all the way back down to 4.69. So yes, the Fed can control the short end. The Fed can bring the lower end down. That will happen. There's still a lot of room to go there because the market is still higher. The Fed is still higher than where the market is. But on the long end, I would suggest that people are going to hope that the long end goes higher. Because right now, what I am seeing is the bond market telling you it's not inflation you have to worry about, it's nominal GDP growth. That we are simply not going to get the economic growth that the administration needs, that the country needs. 4% right now on a 10-year is not factoring in inflation, it is factoring in weak economic growth.
I think inflation is going to go up, and I think the huge amount of debt we have to bring to market is going to cause interest rates to rise. And my opinion, and the MOVE index has been showing signs of life lately. So there's going to be some volatility in the bond market. And my call is for 4.5 to 5 on the 10-year by January.
4.5 is where it has been basically for 2 or 3 years. So if it goes to 4.5, that'll be a benign market outcome. Nobody in the bond market would be upset about 4.5.
Barton, thank you.
Thank you, Barton.
Rachel.
Just a quick question for you. I saw somebody bring up in the chat, David. There's some suggestion that the Supreme Court could knock down Trump's tariffs.
Yeah.
And some have speculated that that actually could have a negative effect as well if all of a sudden they disappear. Can you talk about that?
Well, they won't disappear is the issue, and it certainly wouldn't be a negative effect, but I have seen some of that coverage too, and I accept it might add a certain degree of instability. The Wall Street Journal did run a story a little over a week ago as to why they thought the Supreme Court is highly likely to rule in the administration's favor. And I believe it was my friend Mark Halperin who said he's not so sure he agrees with that assessment. And I'm definitely not so sure I agree with it, but I don't trust myself to distinguish between what I believe the court ought to do and what I believe the court will do. The appellate court ruling was the right ruling on a matter of law, and I hope that by a 5-4 vote, the Supreme Court will uphold it. But even then, the administration is already very well teed up for trying to move to 301 and 232 rationales, essentially moving from economic emergency, which is a somewhat ridiculous argument on its face, that by calling trade deficits an emergency, we've been in an emergency for 58 of the last 60 years, and it doesn't quite pass the vocabulary test of the word emergency. I do think there's a good chance the Supreme Court will rule on the side of the past 2 courts that this is an egregious violation of Article 1 and of the intent of the Emergency Economic Powers Act. But I don't think it's going to matter, because the administration will have a different procedure they have to go through and a longer timeline. And for anything that goes through through 301, they'll end up having to renew it more often. But they intend to just pretextually change the rationale for what the tariffs will be. There are items that will skirt through, that will not fit in. And so all things being equal, for those who favor less tariffs than more, it will be beneficial if the court eliminates that current rationale, which is the most sweeping of rationales. It enabled the administration to use trade deficits as a legal basis to do it. I think it's a coin flip as to what the Supreme Court does. I don't understand the legal aspect enough to get why an appeals court could say something is illegal, which they did, and they're allowed to keep doing it.
Yeah.
I just don't understand that.
Yeah. Because they know they're not the last word. David, tell folks real quick, who should read Dividend Cafe? Like, who's it aimed at, your newsletter?
I really believe that anyone who wants a reasonably readable, understandable approach to investment market should read it. I think we have a lot of very sophisticated investors who read it, and a lot of newcomers and novices. I want people that are interested in learning more about the economy to read it. I'm a center-right conservative who doesn't hide my political views, but tries to write with a certain objectivity as to what I think it means in investment markets, call balls and strikes. So to me, it is not meant for only very sophisticated or wealthy investors, but nor is it meant to be a kind of investing for dummies piece. I think it's for those who want to learn more and hopefully do so with peace, love, and understanding.
I don't just read it for the jokes, but the jokes are very good. Sign up for David's newsletter. It comes out every day. It's absolutely free. tway.tv/TBG, the Bahnsen Group. tway.tv/TBG. David, always glad to have you here, and honored to partner with you for the time you're back with us. So thank you.
Thanks,
Grateful
Mark.
to you. Our sponsor again tonight, our good friends at Cozy Earth. And what's great about them is great stuff. You've heard me talk about before. The bedding's great. The shirts are great. But you also hear me talk quite a bit about the pants. And we got a letter this morning I read on the morning meeting from a guy, a famous viewer of the morning meeting, who said he can't get enough of the pants, and he doesn't like buying clothes, hates clothes, he said. I don't know if he's a nudist, but he said he hates clothes. But he says his wife says he looks great in the pants. Here's the thing about these pants and why I recommend you buy them. You got your drawer with all your pants, maybe a shelf, maybe a drawer, wherever you keep your pants. These pants, you go over like Jerry Seinfeld, his favorite T-shirt. All I do, I got about 6 pairs of pants that fit me. I just take these every time. These are the kind of pants to take them every time. So if you need a good pair of pants, you need your like go-to pants. A man, woman, a child, go to cozyearth.com, buy them. 40% off. Use the code two-way for 40% off at cozyearth.com. Built for real life, made to keep up with yours. Cozy Earth, telling you, buy the pants. That was a delicious video experience. I think you'll agree. Now, what you need to do in return for getting to enjoy that is hit the subscribe button, be part of the Two-Way community, never miss a thing.